So what is happening in Indian economy? First of all, thanks to some of the good fund houses like Kotak Mutual Fund and Ikigai and Motilal Oswal, from where we have collected these data points, and I'll share that with you.
Hi everyone. First of all, thank you for taking your time out and joining us from your busy schedule. At AIF PMS Experts India, we are thrilled to introduce our brand new show called Ask the Expert Show. Through webinars, we aim to share insights into diverse asset classes, exchange knowledge with our investor community. So, my name is Devanshu Bindlish, and I am the Vice President of AIF PMS Experts India. With me, I have someone special and the speaker, Mr. Vikas Agrawal, founder and CEO of AIF and PMS Experts India. And the topic of webinar is to share our house view on markets as the markets are extremely volatile from the last few days. Let me take a moment and introduce Mr. Vikas Agrawal. It's my privilege to introduce him well. Mr. Vikas Agrawal is an MBA graduate with specialization in finance. He also pursued various investment courses from Flame University, Pune, with over 2 decades of expertise in the asset and wealth management industries. Mr. Vikas Agrawal has emerged as India's most trusted voice when it comes to investing in alternative investment funds and portfolio management services. He also shares insights to investors via his blogs, podcasts, and periodic webinars. Hello, Mr. Vikas. Welcome to Ask the Expert Show. Over to you.
Yeah, thank you, Devanshu. Based on the request from most of the investors, because markets are very volatile, they wanted to know more about what's happening in the economy. A. B is they also wanted to understand what are our views on the market. So I thought, we've done some homework. We'll try and share some data points if that can be used as some sort of analysis for them to be able to take right decisions. So let's move ahead. If you give me the rights to share the screen,
Yeah, sure.
I'd like to just share the presentation and
I think you can share the screen.
right. Yeah. So can you see my screen?
Yeah, I can see your screen.
Okay. So is this visible?
Perfectly.
All right. We'll start the conversation. So first of all, thank you. First of all, Devanshu, thank you for introducing me. I can see there are some investors who have joined here for the first time. So I welcome all of them here with the bottom of my heart. Thank you so much for taking the time out from your busy schedule and joining the call today. What we're going to do is to share our views, our house views on the markets. So that's about us, AIF and PMS Experts India. We try to provide different analysis altogether today. It's about AIF and PMS Experts India. As you can see, when you follow a right inputs and when you have a good process in place, then you see the outcome is either immense or they are similar to what you are expecting them to be. So our attempt in the wealth management industry is to ensure that we have right processes in place, processes in terms of selecting the right portfolio managers, constructing the high quality portfolio, and that will give us the kind of expected outcomes that we are looking out for. That's about us in terms of our media interaction. Uh, I always tried my best to educate as many investors as I can through various blogs, podcasts. In fact, ever since we've started, we've completed about 4 years now. In the last 4 years, we have interviewed more than 208 portfolio managers. That clearly indicates the kind of consistency that we have as an organization. At the same time, our commitments which is non-negotiable, which is to educate and empower the investor community as a whole. These are process, which I was referring to, where we have something called 3 I's framework. The first I is basically when we evaluate the portfolio managers, we evaluate them on a couple of parameters. So first thing that we look at is the investment style. That's our first I. So there are portfolio managers who have different styles. For example, there are portfolio managers who follow value style of investing. Some of them follow GARP, which is growth at a reasonable price. Some of them may be contrarian. Some of them may have a different framework, which is more of quant in nature. So we look at different styles of the portfolio managers, and basis that we allocate the money, give the mandate to the portfolio managers. The other thing is because we come from research background, we understand what the quality meaning of the quality in terms of stock selection. So we see to it that we like portfolio managers who are quality conscious, as in they're not buying companies for sake of buying, etc. So we see to it that the quality of the portfolio has to clear the acid test, which we have created within the organization. Third is the investment performance. So, what we do not like is the roller coaster ride, as in we don't like portfolios which are either in Q1 or in Q4, and they're very first quarter they may be in Q1, and then second quarter they are in Q2. We like somebody consistently delivering maybe Q2 performance, but consistently delivering Q2 performance for over a period of time. These are sole framework. So basically, this framework is something that we lived through. We have taken a lot of time to prepare this, and what we have seen, I spent about almost 2.5 decades in the industry now. And one of the understanding that I have is, I always see to it that the portfolio managers, what kind of skills they bring on the table, what kind of knowledge they bring on the table, or we also examine that it is only the luck which is working, because there are times when you can be lucky and your portfolio can deliver extraordinary returns. And a lot of investors come to us and say that, look, this portfolio has outperformed, this much of returns, outperformed the peer group, and you should be considering investing with those portfolio managers. So we say clearly no to them, in the sense that until and unless we are very confident about examining the portfolio manager, their thought process, their investment philosophy, and there are 57 different parameters through which we evaluate the portfolio managers. Unless that is clear, we do not approve them. So we always prefer to be on the right hand side, which is high skill and high luck. That is the best position. So skill outperformance while avoiding pitfall of the underperformance and luck-based investments. This is a recognition, as an organization, we were awarded by Financial Freedom Fraternity. They were in association. They had an association with the Economic Times. We got the AIF Achiever Award, where we've created a beautiful platform called AIFPMS.com, where idea is to get more number of good quality portfolio managers and try and work closely with them. That's about me. So what is happening in Indian economy? First of all, thanks to some of the good fund houses like Kotak Mutual Fund and Ikigai and Motilal Oswal, from where we have collected these data points, and I'll share that with you. Headlines are India's current account deficit widens to 1.1% at $9.7 billion in quarter 1, 2025. Manufacturing activities revised from 9-month low to hit 57.5 in October. Strong demand revives India's services PMI in October. India's retail car sales jumped 32% in October, and inventory levels remain high despite that. India's retail inflation hits 9-month higher of 5.49% in September, but that's still under control. So when you look at India, now here when you look at India's share to global GDP continues to grow. And one of the reason is India continues to be the growth engine for the globe, as in India is growing at 6.8%, the GDP growth rate. But when you look at the nominal GDP growth rate, that's about 10.8%. Because if you have to calculate nominal GDP growth, you need to also add inflation number to it. So none of the economy across the globe is able to achieve 10.8% of nominal GDP growth. Given the size where we are, our share to global GDP is moving, and I'll show you the table. It is expected that in next 3 years, our contribution, which is only 4.3% now of across the globe market cap, uh, can reach to 10%. Not because we are only growing, but because some of the economies are degrowing. So it's like a train which is coming and they become more faster when they go in the opposite direction. Uh, so economic activity is at all-time high in India. This is the number since 2020. That clearly indicates that the activities which is happening in India is at all-time high. Talk about number of startups, number of companies, number of the registration, the direct tax collection. I mean, all of them clearly indicates that the activities are very high. Our utilization, the capacity utilization is rising. It has reached to 76.8%, 75% around now. That is also a good sign that our capacity utilization is improving. This is the GST collection. So one of the concerns, some of the investors had is that when you look at data from May onwards, our GST collection is lower than the estimated nominal GDP growth, which is 10.8% as we speak. So when you look at May, it was lower. So only in the month of April, it delivered more than that. Otherwise, you look at May, it is 10%, June 7.6, July 10%, August 10%, September 6.5%, and October 8.9%. Now, this is an indicator that there has been some amount of slowdown. We cannot deny on the fact that there is no slowdown in India. Now we need to look at what kind of slowdown it is, maybe in the next slides. Now, what is going in our favor is that oil price remains subdued and also likely to be subdued when Trump takes over. It was also observed in the previous stint Mr. Trump had in the US is that the oil prices were always in control under his leadership. And we also believe that going ahead, that will not be a concern. And you know that we as an economy are the largest importer of oils. If that is remain controlled, the price $72 per barrel. If it is ranging between the same, between 70 to 75, then one doesn't have to worry about. CAT to remain winning, as in, there are other parameters to look at. CAT cannot be looked at on isolation basis. There are, your investments and your saving. This is also growing up in the overall percentage of GDP. And therefore, we expect a virtuous cycle of higher saving and investments, which will help CAT to narrow down steadily. This is another chart, very important chart. In India, rural demand is clearly outpacing urban demand. Some of us who live in metro cities like Mumbai, Pune, Delhi assume that here the demand is higher. But when you look at the data, this is the last 6 months of data, clearly indicates whether you talk about tractor sale, you talk about two-wheeler sales, you talk about three-wheeler sales. Of course, in three-wheeler, we saw some amount of slowdown. Otherwise, all the numbers are clearly indicating that rural economy is shaping up very well in India. Are we seeing the consumption revival? In the recent quarter, private consumption has locked GDP growth. This is the quarterly number, and you have Q1, Q2, Q3, Q4, and then of course FY2 Q1. Now, this number clearly indicates that growth in private consumption, and we are going to see some amount of revival. These are government finances remain in robust condition. Uh, Clearly, this is the year when we have taken the target to spend 11 lakh, 11,000 and 1100 crores. Almost 12 lakh crores. That's the kind of spending that we want to see. By far, this has been the highest, ever since uh, I have been looking at the balance sheet of Indian economy. So the total expenditure which happened between April to July is only 13,000 crore billion, and uh, April to June is about 13,000. So the percentage of budget estimate was 27%, and budget estimates for FY25 is 48,205. So your corporate tax grew by 5% uh, in in FY25 4 months. That is what is expected, and personal income tax also grew 53% YOY. When you look at the personal tax, so the revenue for government looks to be reasonable. The government capex has slowed down, but this, as I said, that they are likely to spend 11.11 trillion rupees, 11 trillion, 11.11 trillion in rupee term, which is about 11 lakhs and 11,000 crores. So far, in the first financial year, half of the first financial year, they could spend only 4.15 trillion, which is only 69.069 trillion per month. Now, what is expected for them is to cover up in the second half, and the government will certainly achieve this number. Looks like is that they'll have to spend higher now in order to achieve 11 lakhs. So the remaining 6.9 trillion is expected to spend in the next 6 years, because they were busy in first half of the year. They were busy in elections and following you know extreme weather conditions, because in April, May, June we had hit view hitting the Indian markets, and then July, August, September we saw heavy monsoons. And at the same time, government was also involved in managing couple of states election. We saw election major victory of BJP and NDA in Haryana as well as Maharashtra. That clearly gives them more edge, more confidence. From substitute growth to acceleration, uh, as I said, the festive season is coming. There are 50 lakhs wedding which are planned in the next 3 months, because we had wave, then we had monsoon, then we had Shraddh in the month of September. So first half of the year was little difficult, but it is expected that from here it should become more positive. Therefore, we saw some amount of uptick and downtick in two-wheeler, for example, two-wheeler sales. We saw uptick as in it was going up. Then we saw three-wheeler sales, which has gone down. So I think from now onwards, it should improve in the second half of the year. Rise in corporate tax unlikely to lead rise in debt since cash flow of the corporate India is improving. Now, this is the data since 2004, and operating cash profit to GDP ratio has only gone up. Thanks to Government of India, I hope you remember that Government of India reduced the corporate tax rate. It slashed down, and ever since they've done it, it is only improving. So this is the data since 2004, which clearly indicates that it is shaping up well. EBITDA margins have improved compared to the last decade. Again, because of that, India's strong growth and stable macro makes it stand out. The real GDP growth across major economies. And when you look at the last decade, which is calendar year between 2013 to 23, and what is expected from 23 to 28, this clearly indicates that India continues to contribute the highest uh, amongst other emerging markets and also some of the most of the large economies, I would say. So, this is the structural growth of the economy, clearly standing out that it can deliver highest number possible. Uh, so let's look at the equity market now and the valuation, which is the most interesting part. Uh, so we've done some analysis out there as well. So the market capitalization to GDP ratio, well, this is one of the parameters and which is broadly used by some of the uh, some of the large family offices or maybe the fund managers, but more frequently this parameter is being used by Warren Buffett and Berkshire Hathaway. Well, when you look at the last 25 years of data point, the average market cap to GDP is about 84%. By the way, from 143%, we have already corrected to 137% now. So this is one of the parameters. From this parameter, it looks to be that market cap to GDP is high. But you have to look at what are the reasons behind it. So we'll come to that. And secondly, when you see economy which is growing, you will always see at times market cap would be ahead of the GDP, and at times the GDP would be ahead of the earnings. So these things will keep happening. So honestly, one has to really doesn't need to be worried about this thing per se. The market cap to PAT, this is very important slide, and both are on the up move. When you look at the market cap, it has been observed that from 2020, market cap has grown by 241%, whereas the profit after tax, this is at the economy level, and this is the data since 2007 onwards, 2010 onwards, that has grown at 257. So when you are worried about market cap to GDP, you also need to look at during this time, what was the contribution? So between 2010 to 20, you had 84% of market cap vis-a-vis the profit tax, which was at 26%. But when you look at last 4 years, the pool of the profits after taxes, PAT, grew at absolute number of 257%, vis-a-vis the market cap, which is 241%. So there is a clear-cut room for market cap to go up further. India's share of market cap at 4.3%, as I said, globally, when you look at the total market cap of the world is about $100 trillion. And, historically, you look at, we were at about 2.7%. As we grow, obviously, our size is increasing and we are now becoming a very, very important players when it comes to the overall market cap of the world. And next 3 to 5 years, it is expected that our contribution to the globe in terms of market cap can reach to 10%. So we'll come to that also in the next slide. So profits likely to approach 6% of the GDP by FY26E. So all profits, all losses put together, you get the, you minus the losses from the profit, you get the net profit. Now, this was in 2007, I remember, when economy was peaked out. During that time, your corporate profits to GDP was at as high as 7.3%, 7.1 to 7.3%. And in the decade between 2010 to 20, as an economy, we lost out the momentum and it came down to 1.6%. And from 1.6%, that's why people say that it was a lost out decade for us. And from there, 1.6%, now it has gone up to, again, 5.7%. So even when you look at the previous low, which is a 7.1, 7.2, we still have room for our economy. In 25, 26, it is expected that from 5%, it can move to 5.7%. Because of the actual PAT, which is increasing, the corporate profit pool, and thanks to Government of India for slashing down the corporate tax. And as a result of that, the bigger corporates are also able to increase their margins and really don't have to pass the pricing to the end user. So it's basically a chain. So some of the numbers I want to talk about. When you look at another important slide, that the corporate ROEs and the profitability, both are on uptrend. We already seen the PAT levels, profitability. But when you look at the ROEs, return on equity of listed companies, the cycle clearly indicates that this is on uptick and there is a headroom to go. So from 2020, you see it is on the uptrend. 2024 also, it is inching up. And in 25, it is expected to go up further. Now, this is one worry, that the number of firms reporting a miss are the highest since March 2020. So maybe because of the slowdown in terms of earnings, that may be the one of the reasons that when you look at the beat or miss, is taken on a PAT deviation of 4% and more from consensus estimate. So when you have consensus that this is the PAT which is expected to come, the overall numbers of the companies that you track, and you see that only those firms are taken which have consensus available on Bloomberg. First of all, that's a disclaimer here. So this is going up. So that is one of the important thing to be looked at. Then FY25 EPS estimates have seen decent cuts, but FY26 EPS estimates have seen very, very minor cut. And I gave you the reason, as the spending of the government slowed down, and the capex of the government further had gone down. Private sector capex was not happening in the first half of the year, and as a result of that, the EPS numbers have seen some amount of correction. But let's look at the valuations. This is a very important chart where people talk about Indian markets to be expensive, and no denying on the fact that when you look at these numbers and compare that with some of the other emerging markets, for example, China, which is available at 13 K, Japan, which is available at 15 K, and recently we saw that when FII sold equities worth rupees almost 1 lakh crores, we saw the money going to two markets. One, Japan, but Japan is not part of emerging markets, so it's a developed economy. And Taiwan. Taiwan was the only country which saw inflow. Otherwise, FPIs have withdrawn money across the globe. So when you look at Nifty, the 1 year forward is about 20.6, 20 ka P. Historically, it is at about 18. But broadly, when you look at uh, uh, Sensex, it is at about 20 ka P, last 20 years of data points. The mid cap 1 year forward, mid cap 150, which is your 101 company to 250, is at about 31.5, and historical average is of the P of the market is 24.5. Small cap is at about 22. Historically, it was at about 16.9. So valuation wise, when you look at a large cap, 11% premium to historical average. Mid cap is about 29% premium to historical average, and small cap is about 32% premium to historical average. But there are a couple of reasons behind it. One, the index, the construct of the index itself has changed, as in the change in the Nifty composition reflecting in valuations, in the sense that you have higher private ownership, you have higher domestic share and more B2C companies in Nifty, pulling up the Nifty P higher versus history. As in, there were companies which were at low Ps, not doing well, they have been taken out from the index, and all the high quality, high P, high performing companies have been included in the index. So this is one of the reasons that Nifty weights by ownership has changed. Geographically, it has changed, and business wise also it has changed. The other important aspect is the FIIs. We keep hearing from good number of speakers saying that FIIs continues to sell in India. I agree to that. No denying on the fact that they have been the net seller this year, but or in the last 33 months also, when you look at FPIs have been the net seller. On the other side, uh, okay, so this is a number since 2021, and we started witnessing from April 2021, they have been selling Indian equity markets. Then 22, we saw July, they were buying, they started buying, but again, from October onwards, they were selling. Then again, we saw some amount of buying happening between Jan 23 to July 23. And then we saw last month, October, major outflow, close to $10 billion from Indian equity markets. We already covered that it was not selling particularly to Indian equity market, it was a selling of coming out of MSCI index and getting into developed economies. Whereas when you look at when they sold assets worth $10 billion, FIs, the DIIs and the Indian investors, they bought as stocks worth rupees 12.8 billion dollar, not rupees, which clearly indicates that we as an Indian investors have become more mature. And imagine if FIIs would have sold $10 billion of assets, what would happen to markets 5 years back and what is happening now? Markets are down by only 10%. And that is not only the reason. This is one of the reasons. And this liquidity was very well observed by DIIs in India. So our share in the stock market is going up and their share is going down. The biggest outflow, I talked about it, from emerging market equity funds since 2020. And last month was a month when we had more than $10 billion. But they will not have every time this kind of money to take out. And we don't have to worry about this. Is one of the events which has taken place. So where are the FIIs heading? So Asia's FIIs inflow and outflow for October and so far, in $1 million. India saw the maximum amount of outflows, whereas Japan saw some amount of, the last month particularly, a good amount of inflow. Otherwise, China has been the biggest beneficiary. But when you see this trend, it clearly indicates that they are coming out of emerging markets per se, and there are chances that as the US market settles down, as the uh, uh, Fed rate, the Fed meeting, once they settle down in terms of the liquidity, you will see money flowing back in India. This is the very good chart where we saw some of the large events uh, happened in the past, and we saw uh, recovery of that. For example, in 2008 to 2009, this was a global financial crisis, which is also known as Lehman Brothers crisis. And during that time, the market fell down by 66%. And very next year, 12 months after the market crash, it recovered by 127%. Now, one of the thing is, please don't read this 127% as an absolutely similar number, in the sense that when 100 rupees becomes 50 rupees, you go down by 50%. But when 50 becomes 100, you actually deliver 100%. So maybe the right side of the number may be not giving you or misguiding you, not giving you clear idea. But with this example, you can calculate. But despite all that, when we saw US credit rating downgrades happening in 2011, we saw markets falling down by 13%, and very next year it was up by 18%. In 2018, I remember NBFC crisis, which happened in India, markets fell down by 7%. Very next year, it recovered by 15%. COVID was the biggest example after Lehman Brothers crisis, where this fell down by 37%. This is the the Indian index that I'm referring to. And very next year, it recovered by 98%. So now what is happening currently? Currently, markets are already down by 10%. This is slightly old data. As we speak today, the markets have gone down by a good 10%. Now you can imagine what would be the recovery next year. But when you compare that with FII's ownership, so the ownership also clearly reflected that when they sold stocks, they came back. They sold stocks during the Lehman Brothers crisis, they came back. So obviously here also they sold, and there are chances that they would like to participate and they may come back. So here they've sold stocks, which is in the tune of $10 billion. And the highest one which was saw was, when we had a geopolitical worries, and then they started selling. Of course, it took time from November to July. This data is, so almost 9 to 10 months time, 8 to 9 months time they took. And during this time, they sold almost 34% from Indian equity markets. So nothing to worry about. We continues to be the largest, fastest growing economy in the world, one of the largest, and you will see that FII is coming back and participating in our growth story. Clearly, DIIs are the leaders. I already talked about, you have more than 23,000 crores of SIP money coming in at the regular intervals in the markets, almost $3 billion. And then you have DIIs institution also coming together and buying. So the overall DII's share in the overall ownership of the market is going up, and FIIs are going down. So in a way, I can say that we are proud to be an Indian and taking ownership as much as possible in our stock markets. And now we can say that proudly that our markets are not truly dependent on FIIs, and we as an Indian uh, we are proud about that. Control is in our hand and not in their hand. But going ahead, be ready for the volatility. You will see some amount of geopolitical risk again coming back, because Trump is known for his straightforward uh, behavior, as in, uh, he would not shy away from the fact that he would put up the maximum amount of uh, uh, tariff on country like China, and he would also try to push some of the countries like India to ensure that they get some exposure of telecom, maybe with help of Elon Musk, or maybe they try to see to it that uh, the participation of Indian markets in their economy also goes up, which can help them, which can help their companies to grow faster in India. So there is a good amount of interest, and he is known for working in the interest of the American people. And therefore, they would try to push their own agenda as far as Indian market is concerned. Oil prices looks to be in favor at the moment and looks to be controlled, but you never know. US Fed rate, the date was already decided that we'll have at least 6 or 7 uh, Fed meetings lined up next year. And the gentleman already said that no matter what Trump say, but I'm not going to resign from my job. So that is also an indication that there will be huge volatility. Uh, we would say that, take profit in rising market by clearing up your profitability in the rally. So it depends. Like, I would not say that you should follow this. I would say that, you should check with your team of expert. We have at AIF and PMS Experts India, we have team who will reach out to you and help you to understand that where are you overweight, and wherever we feel that you are overweight, we might book some profits, and wherever we feel that you need to be little underweight, we'll try and revise the portfolio. This is something we do it at the regular interval. Also, other thing is, when you look at the data points from 2005 to 2020, and the other data which is 20 to 24, your BSC 500, which is a broad index followed by most of the Indian investors, has already delivered 18.5% returns vis-a-vis 10.9% in the initial 15 years. Now here, when you look at from 2005 to 2024, the average comes to 12.8%. Now here we need to sort of reduce the expectation level of our investor, in the sense that there will be a mean to revision, there will be a average returns which will eventually get compounded, and one has to be very, very careful about particularly the small cap index, because that has delivered almost 26% already in the last 4 years. But when you look at the average returns, are the benchmark has delivered 12%. While there is a room for improvement, no denying on the fact, but since you are coming out of this 26%, 25% kind of returns, obviously you will see some amount of consolidation happen. So therefore, the expectation from small cap should go down further. This is some of the sector-wise analysis. I'm not getting into details. For example, when you look at the historical PE from 2014 to 2024, the automobile sector, the average PE of the market is about 27, currently trading at 23 ka PE. The private sector bank, uh, P is not the right parameter for them, but even when you look at from PB perspective, which is price to book, then also it is below the last 10 years of average. So private sector bank looks to be good from a valuation perspective. NBFC historical P is about 2.4, current is about 2.3. So while the NPA level of some of the micro cap finance has gone in the tune of 5%, uh, but it can be there. It can continue to be. It can continue to grow for some more time till we really see uh, government taking some amount of measurement out there and declining of that. I'm not getting into the sector wise unless Devanshu, you want me to cover the sector wise also the consumer stable, which
No,
is
sir.
at
I think as per the market outlook, we have spoken a lot. So a couple of investor has couple of questions. If you can go for a Q&A round, if you don't
sure,
mind.
sure, sure. Just give me allow me to run two or three more slides and then
Yeah,
we'll conclude. So
sure.
12 months of forward P, the telecom historical P is at 18. This is at 45. So this looks to be this is the time you have to be very conscious about it. But when you look at the utility, again up, uh, the capital goods, the historical is at about 40, and the current number is about 98.9. So one has to really worry about that. So US inflation falls, almost hitting Federal Reserve target, very much in control. Last 10 years trend for yield in US. So US saw immediate 50, almost 50 pips of changes, and now 10 years souvenir yield is about 4.28. RBI actively managing liquidity very well in India, and as a result of that, 10-year government bond yield and the surplus is very much in line with that. So I think impact of Trump win is bullish. Some of the equities I talked about it. Commodities looks to be favorable, although commodity prices fell down by 10%, but during his regime it looks to be good. Crypto I talked about is likely to do well. He likes cryptocurrency. What they are bearish on is equity, commodity, and fixed income. Indian economy, the current account deficit is widened to 1.1%, but nothing to worry about as the investment picks up. Manufacturing activity revised from 9-month low to hit 557.5 in October. Strong demand revives in India. Service PMI in October. India retail car sales jumped 32% in October. India retail inflation hits 9-month high of 5.49 in September. But that's one of the reasons because of we saw uh, import of gold and some of the prices of the variables have gone up, but it can come very much in control. Uh, the share of GDP, as I said, by 2028, our share can go up from 6% to 10%. Uh, so that's clearly good thing. GST collection we've already covered. Uh, Market cap to GDP we covered. Market cap to PAT we covered. India shares we have covered. Returns comparison we have already done it. So long term view is that you continue to look at Indian markets from a long term perspective. You need to look at the gold returns are good and continues to go well. RBI is increasing gold share in forex reserve. That's also a good news. So with that, we'd like to conclude our session here, and uh, thank you so much for giving me patient hearing. Thank you, Devansh.
Yeah, thank you. Thanks, Vikas, for giving a lot of insights about market outlook. Now we have a couple of questions from our investor community. So they are asking us that, let's say, if you want to deploy your own money now, what would be the strategy as a house?
Well, if you have to suppose you have already invested 100 rupees in equities, then continue to be there. Uh, you know, it's a matter of a quarter or two, things will pass by. But if you want to add another 100 rupees here, then I would suggest that instead of deploying in one go, one should go for staggering the investments. We can see some amount of volatility in the next 2 months or so. So therefore, I would, if I have to put money, I would rather put 50 rupees now out of 100 rupees immediately and remaining 50 rupees I'll probably be deploying in the matter of next 1 month to 2 months time. Because this quarter we want to see some concerns coming back to markets. One of the thing is that the earnings have slowed down a bit, but we have to also look at that these earnings were in double digit from last 5 years. Year on year they were delivering double digit returns. Obviously, at some point of time when government of India is also slowed down their activities in terms of spending, also slow down their capex plan. Then obviously we saw because everything is well connected, in the economy. So therefore, there is a concern as far as the slowing down the economy is concerned. But maybe as the second quarter, the third quarter is likely to do well, we'll see fourth quarter picking up. So maybe 50 rupees now and remaining 50 rupees over a period of next 3 months.
Thanks for clarifying that. So here we conclude our session today because we are running the session from 2 o'clock. So here we conclude our session today. So if anybody has any doubts and if they have any queries regarding AIF and PMS or creating their wealth, they can reach us at aifpms.com and they can call us at 8368 Thank you everyone. Have a lovely day. Thanks Vikas sir for giving your time out. Thank you all the investors for joining this call.